So everything we've discussed regarding the structure of the industry outside the US actually applies in the US too, but the CFDs were banned in the US in 2010. So what's happened since? Retail traders have been moving more towards trading options in the US. So they obtain their leverage through essentially implied leverage or implied volatility through trading options. If you wanted to actually trade normal physical assets in the US, the margin requirement is pretty high. So you don't get much leverage. It would be 33 to 50% margin requirement overnight. So 2 to 3 times leverage. And why do you think it's restricted in that way? They banned CFDs and that replaced it. And then everyone's going for options to get leverage. Index, Forex, and commodity futures, there's lower margin requirements, but the tradable set is pretty small, as in your amount of opportunities to make money because of the amount of contracts or assets you can trade is very low. So it's about 60 contracts, typically on a retail brokerage platform. And that compares to potentially 42,000 stocks. So your tradable universe is really small. And this is why options contracts have become very popular in the US, because retail traders can deposit less margin and get potentially much higher return if they make money through trading the option of an asset. And this is obviously a totally separate class in terms of options, but the two most important variables to consider with an option are theta, so time decay, and volatility. Theta, you have to be right by a certain date. Options adds this other element to a trade whereby you're not just long something and you can be long forever. You have to be right by a certain date. Otherwise, your option expires worthless. Volatility. Why is volatility important? Well, the more volatile something is, if volatility goes up, there's more opportunity to lose or make money. Well, risk and opportunity in the asset. So what happens when volatility gets bid up? When volatility goes up, options become more expensive. And retail traders don't understand how to calculate volatility and opportunity properly. So they always, for example, go long something and buy the asset at a level of volatility that doesn't even exist in the real market. So the odds are always massively against them. So what happens in the US is the vast majority of options expire worthless. Retail traders in the US use options as a proxy for simply going long or short the underlying asset without realizing that they have to be right by a certain amount of time, or the volatility that they're either going long or short can't be bared by the underlying asset's real volatility. But there's a very obvious question here. If 70% of options contracts in the US expire worthless, why don't you just sell options all day long? Easy money, right? Wrong. Selling naked options as a strategy constantly just to take money in, as in to get an income, is super dangerous. Why?
Unlimited losses.
Unlimited losses on many of the trades, yes. So if you do that, it's basically like picking pennies up off the railway track. You're playing a very dangerous game. If you don't have significant amounts of money to bail yourself out when you get 1 in 10 wrong, you're going to blow up very, very quickly. Now, do the brokers know this or not? Of course. So if you go on the platform and start naked selling options a lot, the broker's going to just stop you in your account from doing it and ask you to put up significantly more amounts of margin to cover the potential for any crazy losses. You essentially have gap risk in your trades. So you sell a call option, hence giving the buyer the right to buy the underlying asset at a certain price before a certain date. You take in a few $100, congratulations. Go to bed, wake up the next day, the company's been taken over for a 100% premium by one of their competitors, and you're bankrupt. Happens all the time. So that's why it's not that straightforward. Just because 70% of options in the United States expire worthless doesn't mean just go into the market and start selling options every day to make an income. what people don't understand in the US is that buying an option relative to buying a stock or a commodity or an index, buying an option on those products, there needs to be a marginal benefit in addition to owning the option than to just owning it outright. And if there's no marginal benefit, there's no point, because you have to be right by a certain amount of time. So the risk reward has to be much more favorable over the amount of time, and you have to see catalysts that the market doesn't see. And you have to trade at the right price. If you're not trading at the right price, the risk reward will never be in your favor. So again, this massive gap in education and understanding of how these things work exists in the United States. So the options class is a whole different class.